Right now, the money sitting in your bank account does not exist. Not the way you think it does. And the bank knows this. In fact, the entire banking system is built on that assumption, that you will never come to collect it all at once. Today, we are going to walk through exactly how banks work. And it starts simple, almost boring. But somewhere in the middle of this video, something shifts. By the end, you will understand something most people spend their entire lives not knowing. To understand what is happening today, you need to go back about 600 years. Before banks existed, people who had gold had a problem. Gold is heavy. Gold gets stolen. And if you wanted to move it across a country, you needed a cart, a guard, and a lot of luck. So in medieval Europe, goldsmiths offered a solution. They had vaults, they had locks, and for a fee, they would hold your gold and hand you a receipt. The receipt said this person has stored an amount of gold here. Come in any time to collect it. Simple, honest. But then the goldsmiths noticed something. People stopped coming to collect the gold. They just traded the receipts. The receipt became the money. The gold sat untouched. So the goldsmiths started writing extra receipts. Receipts for gold that did not exist. They lent those receipts out at interest. That was the moment the modern banking system was born. And the trick has never really stopped. This is exactly what banks still do today, just not with gold. They do it with your deposits. It has a name, fractional reserve banking. Here is how it works. You deposit $1,000 at your bank. The bank does not lock that money in a vault for you. It keeps a fraction in reserve and lends the rest out. Under the old United States standard of a 10% reserve requirement, the bank holds $100 of your $1,000 and lends out $900 to someone else. That person deposits the $900 at their bank. That bank holds $90 and lends out $810. The cycle continues. By the end of this chain, your original $1,000 deposit has generated nearly $9,000 in new loans across the banking system. Your money did not multiply. New money was created out of nothing by the banking system, legally. And this has been happening your entire life. In March 2020, the Federal Reserve eliminated the reserve requirement entirely. The current official number is 0%. Banks in the United States are no longer required to hold any fraction of your deposit in reserve, not 1 cent. That is not a rumor. That is on the Federal Reserve's own website. If this is already starting to feel wrong, that is a normal reaction. Hit subscribe so you do not miss where this is going. Now let's talk about mortgages. When you walk into a bank and sign a $300,000 mortgage, most people assume the bank reaches into a pool of savings that other customers deposited and hands you that money. That is not what happens. The act of you signing the contract is what creates the money. The bank types a number into a computer. $300,000 appears in your account. It did not exist before you signed. Then you spend the next 30 years paying it back with interest. On a 30-year mortgage at 7% interest, that $300,000 loan costs you roughly $718,000 in total payments. You pay back more than twice what you borrowed. On money the bank created with a few keystrokes, the bank holds your house as collateral. If you miss payments, they take the house. You provide the real-world asset. They provide an entry in a database. And the banks found a way to scale this into something much, much larger. By the mid-2000s, banks had figured out how to industrialize this model. They started handing out mortgages to people who, by any honest measure, could not afford them. No income verification, no meaningful down payment. Adjustable interest rates that would jump after a few years. These were called subprime mortgages. Imagine you are one of those families. You sign a mortgage in 2004 because your bank said it was a good time to buy. The monthly payment is just manageable. Then in 2006, the rate adjusts, and your payment goes up $400 a month. You fall behind. The bank forecloses. You lose the house. But before that happened, the banks had already packaged thousands of loans like yours into financial products called collateralized debt obligations. They bundled the risky mortgages together, slapped a complex name on them, and sold them to investors around the world as safe, high-yield assets. Rating agencies paid by the same banks stamped them AAA, the highest possible safety rating. The investors trusted the rating. The banks knew better. One trader at Deutsche Bank, Greg Lippmann, saw what was coming as early as 2005. He told his colleagues the entire mortgage market was built on debt that would never be repaid. They ignored him. He bet against the market. When it collapsed, he made $1.5 billion. In September 2008, Lehman Brothers filed for bankruptcy with $691 billion in assets on its books. It remains the largest corporate bankruptcy in American history. In the 2 years that followed, more than 6 million American families lost their homes to foreclosure. In 2008 alone, 3.1 million foreclosure notices were issued across the country, roughly 1 in every 54 households. Think about your street. 1 house in 54 received a notice that year. The banks that created the crisis did not collapse. Congress passed a $700 billion rescue package called TARP, the Troubled Asset Relief Program. Taxpayer money bailed out the institutions that caused the crash. That $700 billion is roughly equivalent to funding the entire U.S. Department of Defense for a full year. No senior bank executive went to prison. You might expect that 2008 changed something fundamental. And some things did. Capital requirements went up. New regulations passed. But the core structure, the one where banks create money from deposits and count on government rescue if they fail spectacularly, is still intact. When COVID-19 hit in 2020, the Federal Reserve responded the way it responds to every major crisis. It created money. Between early 2020 and late 2021, the Federal Reserve's balance sheet expanded from $4.2 trillion to $8.8 trillion. That is $4.6 trillion added to the financial system in roughly 18 months. When that much new money floods the system, it has to go somewhere. It flows into assets, stocks, real estate, bonds. People who already own assets see their wealth increase. A homeowner who bought in 2019 watched their property value jump 40% in 2 years without doing anything at all. People who hold savings in a bank account see their purchasing power quietly erode as prices rise around them. This erosion has a name: inflation. In 2022, United States inflation hit 9.1%, the highest level in 40 years. Groceries, rent, gas, all climbed faster than wages. Real wages, adjusted for inflation, fell. The people least able to absorb rising costs absorbed the most of them. This is not a coincidence. It is a predictable outcome of how the system is designed. So let's come back to where we started. The money in your bank account is not sitting in a vault. It is not fully backed by anything. It exists as a number in a database, held up by confidence, regulation, and the assumption that not everyone will try to withdraw everything at once. Because if they did, the bank could not pay. The Goldsmiths trick from 600 years ago is still running. The receipts just look different now. Here's the question I will leave you with. If a bank can generate $9,000 in new loans from your $1,000 deposit, and a central bank can add $4.6 trillion to the economy with a policy decision, then who is actually in control of the money supply? And more importantly, who benefits most when they use that control? Think about that, because the next video goes deeper into the institution that sits at the center of all of this, the Federal Reserve, what it is, who controls it, and what it actually does with that power. Subscribe so you do not miss it.